Module 4, Blue Chip Dividend Investing. Dividends play a significant role in blue chip investing and can provide several benefits to investors. Here are the key reasons why dividends are significant in blue chip investing. Income generation. Dividends provide a regular income stream for investors. Blue chip stocks, known for their stability and financial strength, often pay consistent and reliable dividends. Investors, particularly those seeking income or a steady cash flow, can rely on these dividends to meet their financial needs. Dividend growth. Many blue chip companies have a history of increasing their dividend payments over time. Dividend growth is a positive indicator of a company's financial health, profitability, and management's confidence in its future prospects. Investors who hold shares of dividend-growing blue chip stocks can benefit from an increasing stream of income over the long term. Total return. Dividends contribute to the total return of an investment. When evaluating the performance of blue chip stocks, it's important to consider both capital appreciation and dividend income. Dividends can enhance the overall returns generated by a stock, especially during periods of market volatility or when capital gains are limited. Stability and lower risk. Blue chip stocks are typically associated with established companies that have a history of stable earnings, strong cash flows, and a solid financial position. These companies are often less prone to extreme stock price fluctuations compared to smaller or riskier companies. Dividends from blue chip stocks can provide a level of stability and lower risk to an investor's portfolio. Portfolio diversification. Dividend-paying blue chip stocks can be an effective way to diversify an investment portfolio. They tend to represent companies from different sectors and industries, offering exposure to a wide range of economic activities. Incorporating dividend-paying blue chip stocks alongside other investments can help balance risk and potentially provide a more stable portfolio. Investor confidence. Companies that consistently pay dividends demonstrate financial discipline and a commitment to returning value to shareholders. Dividends can be seen as a signal of a company's stability, financial strength, and management's confidence in future cash flows. Investors often view dividend payments positively and may be attracted to blue chip stocks as a result. It's important to note that while dividends can be advantageous, not all blue chip stocks pay dividends, as some companies may reinvest their earnings back into the business for growth or other purposes. Therefore, when considering blue chip investments, investors should evaluate both dividend-paying and non-dividend-paying companies based on their overall financial strength, growth prospects, and other relevant factors when evaluating dividend-paying blue chip stocks. There are several key metrics to consider. Here's an overview of dividend yield, dividend payout ratio, and dividend growth rate. Dividend yield. Dividend yield is a financial ratio that represents the annual dividend payment per share relative to the stock's current market price. It helps assess the income-generating potential of a dividend-paying stock. The formula for calculating dividend yield is, dividend yield equals annual dividend per share / stock price, x 100. A higher dividend yield indicates a higher income stream relative to the stock price. However, a high dividend yield may also suggest that the stock price has declined or that the dividend payment may not be sustainable. It's essential to compare the dividend yield of a blue chip stock with its historical yield and with other stocks in the same industry for better context. Dividend payout ratio. The dividend payout ratio measures the proportion of a company's earnings that is distributed as dividends to shareholders. It helps assess the sustainability of dividend payments and the extent to which a company retains earnings for reinvestment or other purposes. The formula for calculating the dividend payout ratio is, dividend payout ratio equals dividends per share / earnings per share, x 100. A lower dividend payout ratio indicates that the company retains a larger portion of its earnings for reinvestment, debt reduction, or future growth opportunities. On the other hand, a high payout ratio may indicate that the company is distributing a significant portion of its earnings as dividends, potentially limiting its capacity for reinvestment or future dividend growth. It's important to consider the industry norms and the company's specific circumstances when evaluating the payout ratio. Dividend growth rate. Dividend growth rate measures the annualized rate at which a company increases its dividend payments over time. It provides insights into the company's commitment to growing its dividends and the potential for future income growth. Dividend growth rate can be calculated using the following formula. Dividend growth rate equals current dividend per share / previous dividend per share, 1/n1, where n represents the number of years over which the growth rate is calculated. A higher dividend growth rate suggests that the company is increasing its dividend payments at a faster pace, indicating strong financial performance, earnings growth, and management confidence. However, it's important to assess the sustainability of the growth rate by considering factors such as the company's financial health, earnings stability, and future prospects. When evaluating dividend-paying blue-chip stocks, it's important to consider these metrics in combination with other factors, such as the company's financial stability, growth prospects, and industry conditions. Additionally, historical trends and comparisons to industry peers can provide further insights into the company's dividend performance and potential. Building a dividend-focused portfolio involves selecting a collection of stocks that have a strong track record of paying dividends and have the potential for sustainable dividend growth. Here are some strategies for building such a portfolio and the benefits of compounding returns over the long term. Research dividend-paying companies. Identify blue-chip stocks and other established companies that have a history of paying dividends consistently. Look for companies with a strong financial position, stable earnings, and a track record of increasing dividends over time. Focus on industries known for dividend-paying stocks, such as utilities, consumer staples, healthcare, and financial sectors. Dividend aristocrats or dividend achievers. Consider including stocks from dividend-focused indexes like the dividend aristocrats or dividend achievers. These indexes comprise companies with a long history of increasing dividends annually. Investing in such companies can provide a diversified portfolio of dividend-paying stocks across various sectors. Dividend reinvestment plans, DRIPs. Consider enrolling in DRIPs offered by companies that allow you to reinvest dividends automatically to purchase additional shares of the stock. This strategy leverages compounding returns by reinvesting dividends to buy more shares, potentially increasing your future dividend payments. Dividend yield and growth balance. Aim for a mix of stocks with attractive dividend yields and the potential for dividend growth. Some companies may have high dividend yields but limited growth prospects, while others may have lower yields but higher growth rates. Balancing both can provide a diversified portfolio with income and the potential for long-term growth. Diversification. Ensure your dividend-focused portfolio is well diversified across different sectors and industries. Diversification helps reduce the risk associated with any single stock or sector. Include a mix of companies with different market capitalizations and geographic exposure to further diversify your portfolio. Benefits of compounding returns over the long term. Accelerated growth. Compounding returns allow you to earn returns not only on your initial investment but also on the reinvested dividends. Over time, this compounding effect can accelerate the growth of your portfolio. Income growth. Reinvesting dividends through compounding can lead to an increasing stream of dividend income. As the number of shares in your portfolio grows, so does the potential for receiving higher dividend payments. Long-term wealth accumulation. Compounding returns can significantly contribute to long-term wealth accumulation. By reinvesting dividends and allowing your investments to grow over many years, you can harness the power of compounding to build substantial wealth. Risk mitigation. Dividend-paying stocks often exhibit more stable performance compared to non-dividend-paying stocks. The income generated from dividends can help mitigate the impact of market volatility and provide a steady stream of cash flow. Retirement income. A dividend-focused portfolio can be particularly beneficial for generating income during retirement. The combination of dividend payments and potential dividend growth can provide a consistent income stream to support your retirement needs. It's important to note that dividend-focused investing requires thorough research, continuous monitoring of the portfolio's performance, and considering individual investment goals and risk tolerance. Consulting with a financial advisor or conducting in-depth analysis can help in building a well-structured dividend-focused portfolio that aligns with your financial objectives.